GPIX, a smarter covered call play on the S&P 500. This article was written by the Alpha Analyst. Summary. Pause. Goldman Sachs S&P 500 Premium Income ETF offers a dynamic covered call strategy, 25 to 75% notional, aiming for higher growth and yield than SPYI with manageable volatility. Recent performance shows GPIX outperformed SPYI in total returns, validating its active approach and upside capture potential in certain markets. GPIX maintains a healthy yield, approximately 8%, and acceptable NAV protection, making it suitable for income-focused investors seeking reduced volatility. I recommend layering into GPIX now, especially post-bull run, while recognizing SPY still outperforms long-term. GPIX excels in tactical and income strategies. Not too long ago, I had analyzed an option-based strategy on the S&P 500 SPY and found it good, with lower volatility backing long-term total return. Typically, I start off on option-based plans with an expectation that overall total returns will be lower than holding the underlying, say, SPY. However, as long as the drawdowns are better managed, the income plan's objective is deemed met, i.e. generating passive income while keeping the NAV as intact as possible. Any drastic NAV erosion leads to shrinking future payouts in absolute terms. The Goldman Sachs S&P 500 Premium Income ETF, GPIX, promises to be better than SPY on paper. The ETF holds cash equity, not synthetic futures. Replicating the S&P 500, it is not entirely passive. The rebalancing to match S&P 500 is active, and so is the option writing strategy on the underlying holdings. The theoretical difference in GPIX, which gets me interested, is that the covered call is a dynamic 25% to 75% of the notional portfolio. If implemented correctly, that should translate to higher growth overall at the expense of higher volatility. I had found similar promise in GPIQ, but performance details didn't show the promise translated into action. Of course, the tenure is not long enough to conclude either way, but a look at GPIX performance against SPY could be telling. Yield and NAV balance good. The tenure is not big enough, but NAV protection is fairly acceptable. The tariff sell-off saw a drawdown of less than 20%, similar to broader markets, S&P 500, while still generating yield. The yield is healthy at approximately 8% on average and ensures not too much is eroded from the capital deployed. This is how the structure will work over the long term. In correcting markets, the premiums earned cover the yield fully or significantly, and the NAV erosion will only reflect market drawdowns, as seen in the limited time of corrections in 2025. In flat markets, NAV should hold up, and again, premiums earned will likely fund the payouts. If the premiums are low volatility or GPIX takes a low notional exposure of 25% of cash-secured calls, a part of the capital may be used to fund the payouts. In an upward rising market, the yield is more likely to be funded by capital payouts, performance against SPYI, since the strategy is active. Its historical performance counts. If GPIX has got the call on how much to cover through options correct, ideally 25% when there is a rally and 75% in pressurized markets, it should do far better than SPYI in total returns terms. The upside cap and resultant opportunity loss in setups like SPYI should be more restricting for total returns than GPIX. It's a relief to see GPIX do better total returns than SPYI. Much of that is attributable to the initial gains, which got maintained since. If we remove the first few months, the differences are not meaningful. That is not a problem. Just goes to show that GPIX should be expected to show significant alpha to other standard option strategies. Fixed exposure to options, approximately 100% of assets held, once in a few quarters, and will be in line with them otherwise. Investors should expect the active call that leads to this alpha to underperform sometimes as well. But history so far shows GPIX has got it right once and never got it wrong. That's not enough data, but tilts the thesis for GPIX towards a buy. The buy on not being worse than SPY is powerful enough. The theoretical promise of better upside and that showing up in performance further strengthens it. I am not doing a separate analysis of drawdowns, because as seen in GPIX's tenure so far, it closely replicates SPY. which means optionality of upsides in certain markets without extra drawdowns. That's empirical evidence so far. Over a long term, expect more of that. But some drawdowns to be sharper than SPY. GPIX is a buy. I would layer in some investments into GPIX now and build over time as more performance data flows in. Here's the thesis summary. SPY is a great asset to ride for an income plan. It's not as volatile as QQQ, makes it easier for an option strategy to follow it closely on upsides. Volatility is lower, so less sharp corrections. Overall growth is expected to be good enough to keep NAV intact. Key criteria for an income plan. Unless your objective is more aggressive payouts de-risking you from the underlying. Proceeds to be invested elsewhere. GPIX is SPY plus the optionality of outperformance in certain market conditions where rallies are better captured. Buy GPIX along with SPY and transition more into GPIX over time. Looking out for more performance metrics. Overall, though, keep in mind that a holding in SPY with periodic payouts will outperform GPIX, including its income in the long term. That is evident in the total return differences between SPY and GPIX. The use case for GPIX is to reduce volatility while generating the income and without self-styled payouts from a SPY investment. GPIX also works really well just after a bull run. Tactical use, such as now, where markets are more likely to stay flat or correct. Even if the rise in SPY is gradual and not a sharp rally, GPIX will be able to capture a lot of the upside move as well. Those probabilities for tactical use for GPIX is open now. Long-term use is also well supported. This article was written by the Alpha Analyst.